SpaceX stock fell more than 30% from its post-IPO high. Then, something that looks completely bullish happened. SpaceX launched a bond offering targeting at least $25 billion, and Reuters reported nearly $85 billion of investor orders. At first glance, that sounds like Wall Street voted yes on SpaceX, but it did not vote on the same investment that SPCX shareholders are buying. Bondholders are lenders. They are paid interest first, and they rank ahead of common stock if the company runs into trouble. Shareholders are buying whatever is left after debt, capital spending, and future execution costs are paid. So this video is about one question. What does $85 billion of demand for SpaceX debt actually mean for someone considering SpaceX stock? Because the answer is more useful and more cautious than the headline. The timing matters. SpaceX is moving through 3 different market events in a very short window. First, the debt offering gives the company additional financing capacity. Second, on July 7th, SpaceX is scheduled to join the NASDAQ 100. That creates mechanical demand from funds that track the index. Third, the company has a staged lockup structure. After its first post-IPO quarterly results, some restricted shares can become eligible for transfer or sale. Those are 3 different forces: funding for the company, demand for the stock, and potential new supply of stock. They should not be mixed together. The market can react positively to all 3 on one day and still face a very different risk-reward profile a few weeks later. On June 23rd, SpaceX launched a 5-tranche senior unsecured notes offering. The maturities run from 5 years to 30 years. The stated uses are straightforward: repay borrowings under a bridge loan facility and support general corporate purposes. That matters because SpaceX is in a capital-intensive phase of its AI expansion. Data centers, computing hardware, and power infrastructure require enormous upfront spending. The nearly $85 billion order book is a positive signal. It says large fixed-income investors were willing to lend at the offered terms, and the company had just received investment-grade ratings. But this is the key distinction. A bond investor asks, can SpaceX service this debt and repay principal? A stock investor asks, can SpaceX earn enough incremental cash flow to justify the equity price after funding all of its ambitions? Those are not interchangeable questions. The bond deal improves confidence in liquidity and refinancing capacity. It does not automatically improve the expected return on SPCX shares. In fact, it raises a more important question. What return will SpaceX earn on the capital it is now able to raise?
The core debate is not whether SpaceX can raise money. The bond order book suggests that it can. The core debate is what happens after the money is raised. SpaceX has one proven cash engine: connectivity, led by Starlink. In 2025, that segment generated about $11.4 billion of revenue and about $7.2 billion of segment-adjusted EBITDA. But the incremental spending is concentrated in AI. The AI segment generated about $3.2 billion of revenue in 2025, while recording an operating loss of roughly $6.4 billion. And AI capital expenditure was about $7.7 billion in the first quarter of 2026 alone. Those numbers are not a verdict against the AI strategy. Early infrastructure spending can create valuable assets, but they define the test. For creditors, the company may need enough stability to meet debt obligations. For shareholders, AI spending has to become a productive asset, not merely a bigger capital requirement. That is why the next earnings report matters more than another headline about demand. Investors need evidence on 3 things: AI revenue growth, AI capital expenditure, and the path from adjusted metrics to real cash generation. The next near-term event is July 7th. NASDAQ has confirmed that SpaceX will be added to the NASDAQ 100 before the market opens. Funds designed to track the index need to own the stock. That is mechanical buying, not a fresh fundamental research decision by every fund manager. JP Morgan estimated that the inclusion could draw about $4.3 billion in passive inflows. For a newly public stock with limited freely tradable supply, that can matter a lot. But there are two important limits. First, sophisticated traders can buy before the rebalance. That means part of the index effect may already be reflected in the price. Second, the rebalance has an end date. Once passive funds complete their purchases, the market goes back to evaluating the business, the valuation, the next earnings report, and the available share supply. So, do not interpret July 7th as a final judgment on SpaceX. Treat it as a market structure event. The useful question is not merely whether SPCX rises that day. The useful question is whether the stock can hold its price after the mechanical buying is done. Now we get to the part that changes the market structure again, the lockup. SpaceX does not have one simple single-day lockup expiration. The prospectus describes a staged release schedule for certain early release eligible shares. On the second full trading day after SpaceX releases results for the quarter ended June 30th, up to 20% of those eligible shares may be transferred.
An additional 10% can become eligible only if the stock closes at least 30% above its $135 IPO price for at least 5 of the 10 trading days ending on the earnings release date. That price threshold is $175.50. After that, the prospectus describes additional 7% tranches at days 70, 90, 105, 120, and 135. Then a larger tranche can follow the release of third quarter results. The remaining standard lockup restrictions run to 180 days. There are two rules for interpreting this. Rule 1, these percentages apply to the eligible locked pool, not to every SpaceX share outstanding. Rule 2, becoming eligible to sell does not mean every holder sells. Employees may diversify, early investors may take profits, other holders may remain long-term owners. The reason it matters is simpler than the calendar. The NASDAQ 100 event can increase demand for a limited float. The lockup schedule can gradually increase supply. The next important test is whether demand stays strong when supply becomes less scarce. After July 7th, there are 3 things worth tracking. First, the flow test. Does SPCX hold up after the NASDAQ 100 rebalance is complete? A one-day spike is less useful than stable trading after the forced buying window closes. Second, the funding test. When SpaceX reports again, look at AI revenue, AI operating losses, and capital expenditure together. A higher revenue number is not enough if the capital required to produce that revenue keeps accelerating faster. Third, the supply test. When shares first become eligible for transfer after the Q2 release, watch volume and price behavior. If the stock absorbs new supply without major stress, that tells you something meaningful about underlying demand. If it cannot, the low float IPO dynamic may have been doing more work than the fundamentals. This is a much better framework than reacting to a single bond headline or a single index event. Here is the bottom line. The nearly $85 billion order book is good news for SpaceX's access to capital. It suggests creditors see a company capable of raising large-scale financing. But debt demand does not decide whether SPCX stock is cheap. For shareholders, the next phase is a 3-part test. Can the stock hold after passive index buying fades? Can AI spending produce credible future returns? And can the market absorb a gradual increase in available shares? The bond deal changed SpaceX's liquidity picture. It did not settle the equity math. The first real evidence begins with the July 7th rebalance and becomes more useful when the company reports its next quarter. Subscribe for the follow-up after the NASDAQ 100 event when we can separate a mechanical flow from a durable investment signal. Educational content only, not financial